from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Tesla could be on the verge of reporting its biggest quarter ever with record deliveries of its electric cars. What does it mean for the Model S, X, 3, and Y? We'll discuss. Plus, Facebook facing the fury of Washington and parents amidst revelations the company knew Instagram could be toxic to teens, but didn't do anything about it. The star of the Netflix hit The Social Dilemma, Tristan Harris, joins us to talk about what's at stake and how do we build a safe online future for our children. And a Bitcoin surge to end a rocky week in the markets. The digital currency spiking the most since July. In a matter of minutes, we'll explore what's driving the shock rally. All that in a moment, but first let's get a wrap of the week, which ended on a high note for Bitcoin. What about everything else? Let's bring back our Kriti Gupta. Kriti, wrap it up for us.
Well, Emily, you did see green on the screen today, but tech not driving the charge higher. And you really see that here. The S&P 500 ending 1.2% after the selling you saw this week. This is really a little bit of a technical bounce. But as I pointed out, big tech was not driving today's action. What was even worse, those Chinese ADRs. We were talking about big tech in U.S. versus China. China really not able to get in on this technical bounce back. Let me just visualize that for you, show you a terminal chart here of what that looks like for the ARK Innovation ETF. This is Kathy Wood's fund that really has that extra expertise, that extra focus in tech in particular. This does include Chinese ADR. So you can see on a quarterly basis going all the way back to 2015, this is the first quarterly outflow that we've seen from this fund. So really important to really visualize how severe the tech sell-off was after this major run-up that you've seen. But let's go back to the intraday story for today, because a lot of it had to do with the biotech sector and Merck in particular that helped some of that reopening trade, that travel trade even higher, coming out and saying that not only does their antiviral drug reduce the risk of hospitalization and death by 50%, it works against all the variants, including the Delta variant. And of course, great news for Merck, but that really did hit some of those vaccine makers and of course bring the NASDAQ Biotech Index into the red by a pretty significant amount, 1.9%, I believe, at the end of the session. Emily, let's see if that turns around next week.
All right, Kriti, thanks for that roundup. Meantime, Tesla is expected to report a record quarter any moment now. Analysts are estimating Tesla delivered 224,000 vehicles in the most recent quarter. This would be, of course, another milestone for CEO Elon Musk. Deliveries are a key barometer of consumer demand for electric cars. Dan Ives of Wedbush joins us now with more. So 224,000, Dan, is consensus. What's your number? How big do you think the quarter will actually be?
Yeah, I think they're going to beat it by potentially north of a 230,000 number. And you take a step back, given the chip shortage, that's about a 10,000 to 15,000 headwind. This is really something back against the wall, chip shortage, some China issues. And I think it's really going to start, a sentiment change in Tesla and very impressive, especially what we're seeing in terms of this green tidal wave shift.
So what's going to make the difference, whether it's 220 or 230? What do you think will account for that, getting it over the line?
Well, I think to put it into months, if you look at July and August, we think combined about 85 to 90,000 units. You look at September, I think it's a month that could approach 145, 150,000. That's significant because the ultimate bull story here is when you take away the chip shortage and some of those issues from China earlier this year, this is a company right now, it's on a run rate of probably north of 1.5 million units next year. And I think that's what the street's focused on. It's also profitability. If you look at the margin profile, especially what we're seeing in China, that's continuing to uptick. And that's part of the broader thesis and part of our $1,000 price target.
How does that set them up for the rest of the year? And is this pace sustainable?
That's a great question. I think going into this, Street thought that 900,000 was basically impossible. Maybe best case 850, 860. Now, especially with the Q4, they could track potentially toward that 900,000 number. And there's about 40,000 units in there that's a headwind just because of the chip shortage. I think as the street starts to sort of triangulate this going into next year and even the next, call it 2 to 3 years, you're looking at a run rate That's even more than bull case. And I think that's because now we're just seeing in China, but we're starting to see this in Europe and the US. And then you get Giga in terms of Berlin up from a capacity perspective, and then Austin next year. This is a company where we're going to be talking about millions of units per year, not hundreds of thousands. And I think that speaks to just the early days of what I view as a $5 trillion green tidal wave globally.
Meantime, Tesla has faced a major setback in China, losing this fraud case sued by a driver, a Chinese driver. What do you think the fallout from this will be on the bigger picture?
I think we've seen it earlier this year. I think Musk, and I think Tesla ultimately maybe, sort of pushed this aside in terms of the issues they were seeing from PR, the Shanghai Auto Show, the safety issues, and now this. I do believe they've navigated a lot of these a lot better than expected. And I think that's something that we're starting to see in terms of the China numbers, especially going into the rest of the year. But these PR issues and some of the legal issues in China, it's important because it's a linchpin in terms of China to the overall bull thesis in Tesla. We think 40% of deliveries next year has come from China. So this is something that Musk and Tesla has taken very seriously. I think you've seen them do a better job in the PR front, but it's important because, along with China, ultimately goes Tesla stock.
All right, Dan Ives, always appreciate you giving us your look ahead at Wedbush Securities. Thanks so much.
Thank you
for joining us. Have a great weekend. All right, another hurdle for the global economy. A metal used in everything from car parts to computer chips has become very scarce. The shortage in silicon metal has driven prices up 300% in less than 2 months. This is blamed on a production cut in China, which was the result of efforts to reduce power consumption. And coming up, continuing fallout from the Facebook files with lawmakers and parents up in arms. What is the future of the social network and how can users take back control for themselves and their children? Tristan Harris, founder of the Center for Humane Technology, joins us next. This is Bloomberg.
This research is not a bombshell. It's not causal research. It's in fact just
well, I beg to differ with you, Ms. Davis. This research is a bombshell. It is powerful, gripping, riveting evidence that Facebook knows of the harmful effects of its site on children and that it has concealed those facts and findings.
Facebook taking center stage in Washington this week as lawmakers grilled the company's global head of safety, Antigone Davis. They're accusing the social network of prioritizing greed over the mental health of its youngest users based on documents leaked to the Wall Street Journal and the account of a whistleblower. Just what is at stake? Tristan Harris, president and co-founder of the Center for Humane Technology, is one of the most respected voices on these issues, most notably in the Netflix documentary, The Social Dilemma. Tristan, great to have you back with us. Obviously you've been talking about these issues for a long time, and I'm curious if you found the recent research that was leaked to the Wall Street Journal bombshell and what you find most alarming about these new revelations.
Yeah, well, in other news, water is wet, right? I mean, this is essentially, we know now the obvious, which is that this business model of monetizing attention is connected to, just like, war is good for GDP. There's things we don't like in society that are really profitable. Suicidal ideation in teenage girls is good for engagement for Facebook and for Instagram. Alienation and body image dysmorphia issues is good for Instagram and good for engagement. There's evidence in the Facebook files that making political parties more negative and divisive has been good for Facebook. In fact, specifically in the Facebook files, there was a change they made in 2018 to the algorithm. And that change caused political parties in Poland and Spain and all sorts of places to actually go 80% more negative and divisive and to basically only get traffic. That shows that these companies have an unparalleled amount of power. Now, with respect to the hearings yesterday, I think everyone's just frustrated because we already knew this, and they're acting like a tobacco company. This is what I think you asked if this is a bombshell. This is a bombshell in that it puts a nail in the coffin on the story, on any doubt that they knew the harms that they were causing, and they continued to prioritize engagement anyway. Now, as you and I both noted, the stock price hasn't moved. Does that mean that investors don't care? Or does that mean that the business model of having a network effect on monopolizing the means of communication? So if you're a teenage girl, I mean, Emily, you and I, we probably use iMessage or text messaging on our iPhones to communicate with each other. But for many teenagers, Instagram messaging is the #1 way that you communicate with your friends. So if you don't use Instagram, you are ostracized and excluded from your community. And they know this, by the way. They design to lock you in. And this is the problem, is that we have something that has taken hostage our country, our teenagers' mental health, and our democracy. And we know that it's bad for us. And even then, the stock price doesn't move. But I'm optimistic because I do think this is the moment to make a transformational change to the business model of these companies. And I think there's a way that that can happen. And I hope that that happens. I think the whistleblower is going to be testifying next week in front of Congress.
We are going to be following that whistleblower's testimony on Tuesday. Tristan, we often hear the argument, well, kids are online anyway, so we have to figure out how to manage that experience. How do you respond to that? And can we trust Facebook to be the one to shape and build that experience? And if not, who should?
It's a great question. The reason why, I mean, the challenge obviously is it's a race for attention. So Instagram says, if I don't do it, I know that TikTok's going to do it. They're going to do the body image filters and the engagement machine. And that's why we call it the race to the bottom of the brainstem. I do think we have to have standards. You know, when I was growing up, we had something called Saturday morning cartoons, and there was time, manner, place restrictions. We had actually child psychologists define what was good for children during those operating hours. And in an unregulated environment, it's just a race to manipulate your kids. And how could we allow this to happen? I do think Apple has a role in because they control the App Store. They're almost like the constitutional sort of central bank of attention, and they can define the terms by which things can interact with children. I also do think we obviously need standards for these companies. I don't blame one company. I see it not as the Facebook files, but as the social media files. And so long as the business model is lifetime, value of a user and addiction is very good for their business and stretching earlier and earlier and earlier into a child's development. So that's fundamentally incompatible, I think, with our society.
So who then is responsible for regulating that experience? Should it be Congress? Take a listen to this from Adam Kovacevic, who was a longtime former Google executive, but now spends his time lobbying in Washington. He wanted to hear more from these hearings, not just penalizing Facebook. Take a listen.
What I hear is parents, grappling with a lot of these questions about screen time, bullying, jealousy, and kids are going through their adolescence online, the good, the bad, the ugly. It would be great to see Congress work together with industry to devise some of the solutions, because I think that's what parents want, but that's not really what we saw today.
So should Congress have this responsibility, and will they actually make it happen?
I think we're at a fundamental crossroads because the private sector has eaten up the public interest, whether it's democratic elections or media. We don't have governments that can define those things anymore. We have technology companies that are defining those things. I do think we need to have, obviously, expert bodies that can actually work out these issues. There is such a way to design technology humanely, though. You don't have to design for maximizing the ability for one person to reach as many people as possible, especially in youth and in the young kids. And I think that decision to say, when you post something as a 13-year-old, it's visible to as many people as possible, that's because that was good for engagement. That's what creates the bullying dynamics from afar, and that's what creates the social visibility to be shamed in public. And that creates the social pressure and social anxiety. But the whole design needs to change. It's not the advertising, it's the whole design model. We don't have to have children that are basically broadcasting their lives from this early. And one thing we know from the Facebook documents, they actually had a slide, I think, called the play date as a growth lever, where they actually said, how do we use the play date to get kids hooked into basically feeling comparison with other kids and to start getting into the sharing treadmill earlier in their lives? We don't have to have that kind of social media. We can have Khan Academy. We can have YouTube that's all about learning. China, as an example, has actually recently created a youth mode. They forcibly required TikTok. For under the age of 14, they limit usage, and they create museum and science experiments you can do at home, museum exhibits. They put all this stuff into the newsfeed more for an educational experience. That's because they see this as a threat. I'm not saying we should do what China's doing, but we need an open society answer that recognizes that we have to do something.
Speaking of China, take a listen to this from Senator Sullivan about China and how that played out yesterday.
Can you really, on your own, help people take a break, or do we, the U.S. government, have to help people take a break like the Chinese are doing right now?
As a parent, I'd much prefer to be able to determine my child's time online than to have China tell me how to raise my child.
Tristan, does China have something right here or not?
I think like I said, I'm not saying we should do what China's doing, but we need an open society answer. Here's the current state of affairs. Right now, it's unregulated, basically a supercomputer pointed at your kid's brain to basically stall the development of children's brains, to basically say, my job is to overwhelm your self-control, because literally the way TikTok and Instagram work is they have $1 trillion of compute power to figure out what's the next video that's going to keep you scrolling, as opposed to giving you a stopping cue that allows you to get up and take a break. In Sesame Street, Elmo gets up and says, hey, do you want to do a little dance? And so he gets the kids up to do a dance. Once the kids are up, now they can actually do something else. Sesame Street would do that because their business model is not screwing up kids and monetizing their attention. But so long as, again, Instagram and TikTok are, we have to have something like that. I do think we need some standards. We had to develop things like the 5 seconds of black, between TV shows. We had to develop things like the Elmo concept in Sesame Street. I think these kinds of things can exist, but we actually have to have them in an open society way, not the authoritarian model that China's doing.
These things are going to take time, and as a parent, I've got 4 children. Every parent is asking themselves this question: how do I gatekeep technology for my child right now? I remember you recommending to adults a digital Sabbath, taking a day off from your devices. What do we do for our children right now when these tools and products aren't necessarily available yet?
I think that oftentimes when we talk about addiction or what kids should do, it feels like we have to sort of tie our hands behind our back and not use it. It's a restraint-driven approach. But the reason that we're so vulnerable to what we call a hyper-normal stimuli, which is a sort of dopamine, extra sugar, extra salt, extra dopamine kind of social media world, is because we live in a hypo-normal, meaning a under-stimulating and under-fulfilling environment. When you don't have social connection or oxytocin or touch or love or just conversation in your life that feels fulfilling, that's what makes us vulnerable. If you were out there doing acro yoga with your friends or sewing or having a really engaging conversation with people you love or something you're really passionate about or dancing, those are the things that actually make us less vulnerable. We don't want to check our phones when we're doing those things. But what we need is technology that steers us in the direction of what lifts up us into a more fulfilling environment so that we don't feel so compelled by these hypernormal stimuli. That's actually the way out. Obviously, to do that, we need to have a collaboration with tech that's not about predating on the vulnerabilities of our children.
So do you think Facebook should be not involved in developing these tools at all? Like, should Facebook stop Instagram for kids entirely? Should we be, looking to Sesame Street to build these products?
I honestly think that the entire thing, TikTok, Instagram, Snapchat, are all bad for children. And if I were to recommend it, I'd say that they shouldn't use them at all. The problem, of course, is that it's not an individual decision for one kid or one parent to make, because again, they have lock-in effects and you'll be ostracized from your community, which again, they do deliberately because they know that's what keeps their users. I do think that Apple has a role in trying to make safer standards, Apple and Google, and setting the standards of the app stores. And hopefully this pressure could lead to some of that to happen because they're above the competition. As you said, if Facebook doesn't build Instagram for kids, that doesn't stop the problem. All the kids are still right there on Instagram anyway, using it. I really do think that all these things are horrible for children, and I would recommend that most parents, if they're looking for just advice, to avoid it as much as they can.
So do we take the iPads away from our kids right now until there are better options, or what?
Well, no, keep in mind the distinction I'm saying here, which is it's not about the technology. It's not this piece of metal. It's not that the rectangle or the glowing rectangle is the evil thing we should feel worried about touching. It's about what is on there. Are the interests of the people designing the technology the same as your interests? I mean, I've studied the Sesame Street history. They had child psychologists who cared about what is the developmental level of children and what's appropriate for that developmental level. And they did that by using all the things we know about television, but then combining it with what would be a fiduciary value or interest to children's development. None of the people who are building this stuff now are doing it in the interest of children. That's the thing that needs to change.
Quick question, Tristan, and I know we could talk about this for days, but the next chapter is the metaverse. How do we get this right for kids and grown-ups?
Yeah, I mean, I think, it's one thing when you run out of attention that people are going to look at on their screens. It's another thing to try to create an entire universe that people are going to stare at through virtual reality and augmented reality 24/7. And that's what they're really competing for. I mean, the way to grow the size of the attention economy is to get people to live in these virtual worlds as much full-time as you possibly can. I think that if we don't get it right at the beginning, I worry where we're going to end up. I mean, I wish that we had these conversations so many years earlier. So many of us have been saying for 8 years that we shouldn't be allowing this engagement-driven business model that focuses on monetizing human attention, as opposed to you're the customer, you're not the product. The key line in the social dilemma is that things that treat you as the customer, not the product. That's the distinction that we need. So what if we had, for the metaverse and for augmented reality and virtual reality, there was no such thing as engagement-driven business models? Would you want a brain implant in your brain, a neurosurgeon installs a brain implant, and the business model of that brain implant was to get you to think certain thoughts constantly, and they wanted you to use it constantly? We would never allow that kind of brain implant.
Right. Questions to ponder as we deal with this. Tristan Harris of the Center for Humane Technology, thank you as always for your thoughtful and nuanced opinions here. Coming up, Zoom's biggest potential acquisition has been scrapped. We'll discuss next. This is Bloomberg. Other tech stories we're watching: Zoom and call center software provider Five9 have scrapped their $14.7 billion merger agreement. A steep decline in Zoom shares cut the deal's value by almost a third. That led Five9 shareholders to reject the offer. Two advisory firms had recommended voting against the deal, saying that Zoom's prospects have fallen in a post-pandemic environment. And a setback for crypto platforms hoping to upend the traditional finance system. A bug in an update of DeFi platform Compound sent users nearly $89 million worth of crypto in error. The CEO is now begging users to send it back. Coming up, Coinbase, Robinhood, and just this week, Amplitude. The public listings keep coming for 2021. After the break, we're joined by NASDAQ Senior Vice President Jeff Thomas to talk about it all. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco. This just in, billionaire Bill Gross was ordered to spend 5 days in jail for flouting a judge's order not to annoy his Southern California neighbor with loud music. That sentence was suspended, citing the COVID-19 pandemic, but Gross and his wife were both fined $1,000 each. Let's get back to the markets now. And Kriti Gupta. Kriti, what else are you watching to end the week?
Well, Emily, we have to talk about IPOs because they were such the rage, all the rage, I should say, at the start of the year. And then they kind of fell a little bit. But it seems like in September, they really made a comeback. I mean, take a look at this. The S&P 500 in the last month has had quite the sell-off, tech stocks being a major part of it. But IPOs like Dutch Brothers, On Holding, Olaplex, they've actually been higher, and by no mere amount. Look at these, 100% doubling almost in value for some of those September IPOs. Pretty interesting considering the broader weakness. I want to zoom out for a second and look at that year-to-date chart, because if you compare the IPO index to the S&P 500, it's been underperforming for the better part of the year, really not recovering back to that February peak we saw, like I said, when IPOs were all the rage. So does that mean maybe people are preferring direct listings? Well, let's check it out, because in the last 5 days alone, 2 major direct listings, Amplitude and Warby Parker, have also been doing pretty well. Emily, if this is an indication of kind of where the new money is going, if they don't prefer tech, if they don't prefer the traditional S&P 500 and ETFs, where's the money going? It looks like they're going into these new direct listings, these new IPOs. That could very much change in October, but something to watch in the month ahead.
All right, Kriti, thank you for that roundup. Kriti, have a great weekend. Well, it's been a record-breaking year for IPOs on the NASDAQ, with over 560 IPOs year-to-date. Companies like Robinhood and more recently Freshworks, Amplitude, and Olaplex have had major debuts, and There's more to come. Joining us now, Jeff Thomas, NASDAQ Senior Vice President and Head of Western U.S. Listings and Capital Markets. Jeff, great to have you back with us. So how do you see this year going down in the record books, especially compared to last year?
We are off the charts. So like you said, we've had over 560 IPOs raising $136 billion, and we're only 3/4 of the way through. If you go back 2 years ago to 2019, we had 124 IPOs for the whole year that raised $24 billion, just to give you about the order of magnitude. Now, a lot of that increase has come from the SPAC IPOs, which are mixed into there. But even if you just look at the operating companies, we've already had over 250 operating companies go public this year. So it's really off the charts.
So let's talk about the SPAC attack and the surge of companies choosing that route. How many of these do you think will actually end up being good bets?
This year, we've already had 84 SPAC business combinations on NASDAQ, representing over $200 billion in market cap. And some really great companies, including SoFi, 23andMe, Lucid Motors. So a lot of really big name companies are choosing this. People say, why look at a SPAC versus an IPO? And one thing I like to say is a SPAC is a lot like an IPO, but in reverse. So in an IPO, you'll get all your paperwork together, go back and forth with the SEC, then do the roadshow, set the price. On a SPAC, you set the price, then you go out, do all the paperwork with the SEC, get your shareholder vote, and then you're public. So it's really a lot of the same process, a lot of the same disclosure, but just a different order of operations.
You had your second direct listing for the year this week with Amplitude, the CEO of Amplitude, I guess one of the youngest guys ever to take a company public, joined us on the show. Coinbase was your first of the year. How many more direct listings do you see coming up? Do you see this as being part of a longer-term trend, or will these continue to be one-offs?
We are talking to about 10 different tech companies right now about a direct listing. Nobody is planning one for the rest of this year, but I think in 2022, we're going to see this trend continue. As you saw, there are about twice as many companies that did a direct listing this year as last year. So we think this is going to continue. As a reminder, right now for a direct listing, you can't raise capital. So this is really for companies that are well-funded through the private markets and are more interested in liquidity versus capital raising.
So let's talk about that. Amplitude shares ended the day up more than 50%. Clearly there was demand there, but they didn't take that opportunity to raise any money for themselves. Was a direct listing really the right call?
You know, they were extremely well-funded. They did a private round this summer, and so they had already raised capital. And so this was all about a liquidity event for them, for being able to go out, give their shareholders the opportunity to sell in the open market. And just the way the stock has traded this week has been phenomenal. So they set the reference price at $35 a share, which was right around that private round this summer. We opened the stock at $50 a share, and it's traded within a really tight range between 54 and 52 all week. So it's been traded like a very mature stock very early in its life.
So what are you anticipating for fall?
So we've got a really healthy lineup of deals coming this fall. So we see a lot of technology, biotech, and retail companies getting ready to come to market. I think people are looking to take advantage of the attractive valuations and the amount of capital that's out there in the IPO market. So they want to go out and raise that capital while the window's open.
And if we're seeing so many companies get out of the gate this year, what does that mean for next year? Next year, could we see a slowdown?
Well, I think as long as there's a good valuation environment, which we have right now, we don't see any sign of that changing, although it's been a little bit rockier lately. And that's one of the things we really watch is the volatility index. So we have seen the tech names trade off a bit as interest rates have gone up. So you've got the 10-year hovering right around 1.5%. That's a key indicator for what the future cash flows of these high growth companies are going to trade at. And so if you see the fixed income market start to rise, that could be trouble for some of the valuations we see.
You're also seeing some more switches to NASDAQ from other U.S. exchanges, which I know is a huge coup for you. What's driving this behind the scenes?
Well, so it all goes back to 2005 when the SEC changed the rule where companies could take their stock ticker to either exchange. And so since they've changed that rule, we've had over $2 trillion transferred from the New York Stock Exchange to NASDAQ. One of the more recent ones was Honeywell, which just joined the NASDAQ 100 index, which was a major reason why they wanted to come join the NASDAQ family. But on top of that, we offer really robust solutions around investor relations, corporate governance, and ESG disclosures that companies want to take advantage of. They also love all the branding and visibility they get through a NASDAQ listing.
Meantime, there are some uncertainties about whether Biden's economic plan, for example, will pass. Tax issues that affect a lot of pre-IPO shares and could impact founders and their decisions to go public and seek that liquidity or raise additional funding on the public markets. How much do you think some of these macroeconomic uncertainties will impact the decisions that founders and CEOs are making over the next 12 months?
I definitely think it's driving a lot stronger activity in the private equity-backed companies. So the private equity sponsors are looking at their alternatives between a trade sale or an IPO for liquidity. And with the potential tax changes coming next year, a lot of them are moving to take their companies public this year as opposed to waiting till next year. Just this week alone, you saw Advent International bring out both Olaplex, which raised over $1.5 billion, and then First Watch, a great restaurant brand, on NASDAQ.
And with the pandemic, obviously, we're coming out of it, but you've had more sort of virtual listings, less people come into the NASDAQ itself to ring that bell. Do you see more of a blended listing day experience to continue in the future, or do you think we will go back to that sort of traditional, we're all here in New York mentality?
Well, our clients' health and safety is really our top concern. So we've got in place some really good protocols around vaccination and testing requirements for those that choose to come to the NASDAQ market site in Times Square to celebrate. As you saw, both Freshworks and Amplitude had really great celebrations. We also had their employees here in San Francisco at our entrepreneurial center watching the bell at 6:30 in the morning out here on the West Coast. So we're really back to those in-person celebrations, but we're not going to lose some of the virtual offerings that make the IPO day that much more inclusive. We actually have a mobile app now that lets employees around the globe watch the bell ceremony, snap a picture of themselves, and then they can post that picture up on our tower in Times Square for a really unique keepsake from their IPO day.
As we've been talking, Jeff, Rivian just filed for its IPO, seeking to list on the NASDAQ. Rivian, of course, the hot electric car maker. There's a long waiting list for Rivian vehicles. Anything you can tell us about this listing?
We've had a really great run here with the electric vehicle segment this year on NASDAQ. So obviously Lucid Motors, that was another one of those transfers from the New York Stock Exchange when they were acquired by a New York listed SPAC, listed on NASDAQ. Of course, our friends at Tesla, Faraday. So there's a lot of interest in this space right now. And obviously Rivian will be an extremely exciting offering for us this fall. And of course, backed by NASDAQ listed Amazon.
All right, big news. Glad we had you here to react to that. NASDAQ's Jeff Thomas, great to have you with us, as always. Meantime, the White House plans to enlist 30 other countries to join forces in the fight against increasingly frequent ransomware attacks and other kinds of cybercrime. Officials say the first meeting will be this month, hosted by the United States and held virtually. The group also plans on looking into illegal use of cryptocurrency. And coming up, crypto is on the docket. Bitcoin's sudden rise. We're going to take a look at the cryptocurrency's sudden leap and the latest in the world of decentralized finance. This is Bloomberg. Bitcoin rose within minutes to its biggest daily gain since July, as much as 10%. This following a slump of more than 7% in September amidst concerns about increasing regulatory pressure in both China and the United States. But the Fed's now coming out with some reassurance, saying they intend on regulating crypto but have no intention on banning cryptocurrencies. Joining me now to talk about this and much more, John Wu, president at the blockchain startup Ava Labs. John, thank you so much for joining us. Obviously, big jump for Bitcoin today. Not, these roller coaster rides, not unusual necessarily. But what do you think is driving this particular, what we're calling a shock rally in particular?
Thanks for having me here, Emily. The shock rally, as you call it, I think people, first of all, like you said, have to get used to some of this volatility. And it is the statements that were made where they don't plan on banning crypto, but possibly just regulating certain parts. And that gave people more certainty that sensible regulation will happen, at least in the US. So that is the hope. And that's why a lot of these coins actually had a very good day.
So if China is banning crypto and the US says it's going to regulate it but not ban it, what are the ripple effects of that?
So what China's doing is actually in line with the trend of what they've been doing for 7-8 years in the cryptocurrency world. This is a little more harsh than normal. And also it's in line with what they're doing with technology. They are coming in and becoming more heavy-handed in their regulation. Luckily, from where I sit as an operator in the space, what I see is that it's actually a incredible boom for decentralized finance and distributed and governance and decentralized applications. If you look at what's happened since the announcements, the decentralized finance and applications in the space have actually increased in volume and usage, sometimes 3-4 times in just the last couple of weeks. So it is classic. They come in and they try to ban it, and users who have such passion, they look for refuge elsewhere and they find a way. And the whole ethos of crypto, again, is self-governance. And they find a way to find the decentralized exchanges as well as the DeFi applications to express themselves.
Your Avalanche is now available on Coinbase as of yesterday. How big a step forward is this, and what do we need to know?
Thank you for recognizing that. It is a big step forward. And I think what it is, it's a vote of confidence for the demand from US individuals for fast and speedy and low cost blockchain where they can actually try some of these DeFi, NFTs, and other social tokens in a way that is also, what's exciting about it for them is that it's also Ethereum compatible, Avalanche that is. So therefore now they can go back and forth and experience different ecosystems and see which features that they prefer. And that's why we are so excited about it. And that's why the users, and hopefully the 68 million users at Coinbase, as well as the incremental US demand that Avalanche will see, will have a very incredible experience.
What do you think the role of Avalanche, or what do you hope the role of Avalanche will be in both institutional and decentralized finance?
Avalanche and Avalabs, the company that the software company behind Avalanche, was started obviously to help create a decentralized, permissionless world. However, the ultimate goal for Avalabs is to enable traditional financial services companies and traditional enterprises to tokenize their assets. It's not just about the $200 billion in the DeFi ecosystem. It's going to be about the $700 trillion of assets that sit on financial services balance sheets. That's our vision at Avalabs for Avalanche. That's why we are so excited. And that's why I see a lot of developers continuing to migrate to Avalanche and trying to tap into basically a great market and provide access to people across the world for financial products that they don't actually have access to now.
There are some traffic congestion issues that are impacting the broader ecosystem, long wait times for Ethereum users, for example. How does your traction on the blockchain compare with Ethereum's or Polkadot's?
So Avalanche is Ethereum compatible, and it is a way to basically be complementary to Ethereum. When there's a lot of activity in Ethereum, Avalanche can easily provide the same ecosystem and sometimes native applications in DeFi and NFTs, but giving them speeds and finality, instant finality and speeds that are probably like 100 times faster. And most importantly, Emily, the cost. The cost is pennies versus sometimes 10, 20, 30, hundreds of dollars for one simple transaction.
What if the entire ecosystem of stablecoins gets regulated, though? Is that a concern?
Great question. In the short term, it is. But in my opinion, if you have clear definition and people understand what is backing these stablecoins and there's transparency, I cannot see how that won't create even more adoption. Obviously, stablecoins now is one of the largest components. And it's done, I can tell you, from talking to people, partners in the space, and as an operator, people who use this, they feel sometimes hesitant because they too don't realize what is underneath the collateral that actually supports these stablecoins. So they gravitate to a few that they are comfortable. If there is proper regulation and transparency into what is collateral, this space will grow even faster.
Okay. John Wu, Ava Labs president, thanks for breaking that down for us. We'll be watching Avalanche. Coming up, as the world of Marvel and DC Comics enter the digital collectible realm, we're going to find out why it may not be good news for the artists behind their success. That's next. This is Bloomberg. DC Comics is getting into NFTs with a giveaway for fans later this month. This comes just months after rival Marvel also entered the digital collectible space. And while it may be good news for publishers and fans, it's causing concerns for some comic book artists. This from Bloomberg's Quick Take.
Quick Takes Madis Kabash, and I'm about to go speak to a comic dealer about NFTs. Now, NFTs, or non-fungible tokens, are a way of classifying artwork through the blockchain, making it possible to sell it in a purely digital form. The comic book industry would be an obvious winner in this, one would assume, but that's not the case, as Marvel and DC have clamped down on sales of NFTs with their characters.
So the comic book industry is predominantly made up of Marvel and DC. So Marvel and DC are the two big players because they own the majority of the IPs that you'll see on TV. So the majority of artists and creators that become big in the industry ultimately will have some dealings with Marvel and DC.
And do they pay well?
That's very dependent on the individual. If you're a new starter, then Marvel and DC tend to pay at a much lower level. What artists make money from is from selling the original artwork.
Okay, so let's cut to the chase. Do you sell NFTs?
Currently, no. Predominantly because of the fact that Marvel and DC do not allow NFT sales of any of their projects from the artists that draw digitally. So that makes it quite hard to sell NFTs. I'd be interested if that stance softens, but as it stands at the moment, we have to wait and sort of see what Marvel and DC tell everybody.
Why do you think they issued this ban? I mean, like, if I can sell the physical original, why can't I sell it in a digital format?
I think the problem is that over the years, because a lot of artists have moved to a digital platform, that ultimately then hurts them in terms of selling artwork because they don't have physical artwork to sell. But if that difference can be bridged and they can effectively sell NFTs, then it will change things dramatically. I think if Marvel and DC soften their attitude towards NFTs, then I think the marketplace opens. I mean, some of those pieces could be sold for thousands.
As we left the Brixton warehouse, it became evident that NFTs are a new frontier. But simply put, they are a way for artists to make more money.
What I wanted to do is do a proof of concept, right? The only way I could show to do that was to burn my own artwork, which in its own way was very cathartic. It sold for $182,000. When I saw that, I'm sitting and watching the auction and I was just like, what?
And what do you think is the potential of NFTs in the comic industry?
A new market like this allows them to not only create, but to tap into other monies. And it also breaks the chains of traditional paychecks.
So Marvel and DC aren't very happy with this whole NFT situation. What's your take on that?
There is a Supreme Court law out there that has been passed that an artist can paint or do can do an original piece. That's theirs. That's their interpretation. That's their everything.
After speaking to artists and dealers in the US and the UK, I wanted to find out just how important NFTs will be in the arc of comic history.
The value that it can bring to different types of creators or consumers is pretty profound. So the main reason that art or collectibles have taken off is because you can pass a royalty so that every time a piece of artist's work gets sold in the future, they receive a cut of that, which is pretty impactful if you're talking about, the full length career of an artist.
Despite the size of the NFT market at the moment, they will be a crucial part of the comic book industry's next evolution. And companies issuing major bans are defining who's going to reap the financial benefits when the time comes.
Any big company that comes in there and wants to take that in and just sort of strangle the artist a little bit, I really think we need to think about it. Think about what they're doing.
In August, Marvel launched into the NFT space via an app called Vivi, selling NFTs of Spider-Man for up to $400. So far, there has been no mention of the creators of the NFTs or the original work. Marvel says they are looking into the issue and will be addressing it in the coming months.
That was Bloomberg Quick Takes, Mattis Kabash there. And that does it for this edition of Bloomberg Technology. Stay with Bloomberg Television. My colleague David Weston coming up with Wall Street Week and some great guests you don't want to miss. I'm Emily Chang in San Francisco. Have a wonderful weekend, everyone. This is Bloomberg.